Okay, let's just dive right into this. Imagine waking up one morning, grabbing your phone, and realizing you're suddenly $10 billion poorer. Well, if you happen to be holding Roblox stock on July 31st, 2026, that wasn't just some bad dream. It was reality. Welcome to this explainer. Today, we're on a mission to decode a massive market mystery. We're looking at a company beloved by over 123 million daily users that seemingly broke its own money-making machine completely on purpose. So let's figure out exactly why. I mean, we're talking about a massive 30% plummet in a single trading session. Poof. $10 billion in value wiped out just like that. Now, what makes this whole situation so incredibly fascinating is what didn't happen, right? There was no massive cyber hack. There was no sudden macroeconomic recession dragging the whole market down. Nothing like that. This colossal drop was basically an inside job. Now, before we really start decoding all of this, a quick but absolutely vital note. The information in this explainer is strictly for educational and informational purposes. It definitely doesn't constitute financial, investment, or trading advice. I am not a licensed financial advisor, and you know the drill. Past performance never guarantees future results. Always do your own research or consult a professional. You can check out our full written disclaimer in the description. Okay, with that out of the way, let's get into the hard data. Here is our roadmap for today's explainer. First, the $10 billion crash. Then a look inside Q2 earnings, the algorithm shift, the analyst divide, and finally, we'll weigh the bull versus the bear case. Part 1, the $10 billion crash, setting the scene. Part 2, inside Q2 earnings, the good versus the bad. So looking at the Q2 numbers, we get this incredibly confusing contradiction. On one hand, things actually looked phenomenal. Revenue hit $1.5 billion, up a massive 36% year over year. Daily active users kept climbing, hitting 123 million, and management even announced a whopping $3 billion share buyback. So far, so good, right? But then came the dark cloud. Bookings grew by a measly 8%, barely scraping the absolute lowest end of their own forecasts. And worse than that, they projected Q3 bookings to actually drop by 14 to 18%, and they entirely withdrew their full year 2026 guidance. That is practically unheard of. Now, if you're wondering why that one specific word, bookings, sparked a $10 billion firestorm, it's because bookings are literally the lifeblood of Roblox. See, while revenue is recognized over time as players use up their virtual items, bookings represent the actual hard cash being spent by users on the platform right this very second. So forecasting a 14 to 18% drop, that means forecasting the very first quarterly bookings decline in Roblox's entire history as a public firm. That is a massive, flashing red flag for any investor looking for short-term growth. Part 3, the algorithm shift, the real culprit. The answer to this whole mystery is actually hiding right in plain sight. It's in one extremely revealing sentence from the CEO's letter to shareholders. Quote, "We're optimizing for long-term retention, not short-term monetization." End quote. Basically, management decided to take a brutal hit to the chin right now in order to build a healthier ecosystem for the next decade. They went in and completely changed the core DNA of how the platform operates. In practice, this is a truly radical pivot. The old recommendation algorithm was all about pushing players toward viral, high-spending games. You know the ones, those experiences perfectly designed to generate quick cash through rapid-fire microtransactions. Well, the new algorithm shifts gears completely. It now prioritizes games that keep users engaged for 28 days or more. We're talking about educational, social, or highly creative experiences, which, don't get me wrong, is absolutely fantastic for community health, but they monetize at a much, much lower rate. And this algorithmic pivot, it had a devastating side effect on one very specific demographic, the under 13 crowd. Now, obviously, these younger users don't exactly have their own credit cards. The parents are the ones controlling the wallets. And right now, thanks to inflation, parents are guarding those wallets like a video game final boss. So when the platform suddenly stopped aggressively pushing those addictive impulse buy games to the kids, the parental cash flow essentially just dried up. Part 4. The analyst divide. Wall Street reacts. Because of all this, Wall Street is completely split on how to price this long-term vision. It's a real mixed bag. On the bullish side, Oppenheimer actually maintained an outperform rating, but they still slashed their price target down to $50. Citi kept a buy rating at $60, seeing this as a sort of painful but necessary transition. And CICC echoed that sentiment exactly with a $58 target, calling it a strategic long-term investment. But man, the bears are equally vocal here. Deutsche Bank downgraded the stock to a hold at $38, citing reduced near-term visibility. And Benchmark, they completely slammed it with a sell rating and a $33 target, warning that this might actually be the start of a product lifecycle decline. To put that into perspective, across 36 different analysts, the average price target sits around $51. But just look at how wild that range is. It spans from a low of $33 all the way up to a high of $72. The main takeaway here is actually pretty simple. Absolutely nobody on Wall Street truly knows where this stock is headed over the next 6 months. Management's complete lack of a clear timeline has basically created a giant vacuum of certainty. Part 5. The bull versus bear case, the verdict. Let's lay out the optimistic view first, the bull case. Number 1, you simply cannot ignore 123 million daily active users that are still actively growing. That is a massive, highly captive audience. Number 2, their age verification is now over 57% globally, and incredibly, it's over 70% in both the US and the UK. That is absolutely crucial because it builds vital, long-term trust with both parents and regulators. And finally, that $3 billion share buyback we mentioned, that acts as a massive structural safety net, giving the stock price some significant near-term support while the company figures out this messy transition. But on the flip side, we have to look at the pessimistic view, the bear case. Look, if this bookings decline actually persists deep into 2027, Roblox is going to seriously struggle to justify its current valuation, period. Furthermore, changing your core algorithm to suddenly focus on 28-day retention, that's the kind of thing that could take years to actually show real financial results. Actually, scratch that, it will take years. And during all that time, fierce competitors like Fortnite and Minecraft are absolutely not standing still. They are out there fighting tooth and nail for that exact same user attention and wallet share. So when you boil it all down, the crucial point is this. Roblox is attempting to become the YouTube of gaming. It is a massive, high-risk, incredibly high-reward ecosystem transition. Management firmly believes that a platform where safety and long-term retention win out will ultimately be way more valuable than one relying on short-term monetization tricks. But as we all know, Wall Street absolutely hates surprises. And for the next few quarters, for sure, this stock is going to trade purely on bookings growth and retention trends, not on the hype of what it could potentially become a decade from now. Before we wrap this all up, just a final, quick reminder that this explainer is strictly for educational purposes, based purely on publicly available data. This is definitely not a recommendation to buy or sell any security. Markets are incredibly unpredictable, especially when you're caught right in the middle of a massive corporate pivot like this one. Always do your own due diligence and never risk what you simply cannot afford to lose. So I'm going to leave you with this final provocative thought. Management essentially made a conscious choice to break the machine in order to build a better one. But is this $10 billion haircut the actual bottom for Roblox, or is there even more pain ahead as this new algorithm truly takes root? I'd absolutely love to hear how you guys are interpreting all this data. Drop your thoughts and theories in the comments below. And hey, if you found this structured dive helpful, be sure to engage with the explainer so you don't miss our next investigation. Thanks so much for joining me today, and keep learning.